Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over the recent downward trend that we're seeing in the gold price and explain what forces are pushing down and suppressing that gold price, and will we see a turnaround and when that might be. So in the last couple of months, gold has dropped off from reaching a peak of about $2,050 an ounce in March, and it has dropped nearly 10%. Silver has performed similarly, dropping from a recent peak of 26. It's not its total high, and it has dropped by nearly 20% down to below $22 an ounce at $21.78. After the run-up in gold and silver prices that we have been seeing since the onset of the pandemic, we've really largely seen gold stall out for the last year and a half, and silver. Why? Well, recently I have created a gold valuation tool that has basically fine-tuned the economic forces that push down on the gold price or push up on the gold price. One of the things that is the major factor is obviously the money supply. The second is the dollar index, how well the dollar performs against other currencies. The stronger the dollar, the weaker the gold price. The weaker the dollar, the stronger the gold price. The other thing is that how well stocks are performing to interest rates and GDP growth. The higher that stocks trade to versus interest rates and GDP, the more depressed gold prices is, because that tells you that investor money flows are going into US dollar denominated assets, namely in that case stocks and equities, versus going in and flocking to safe havens. Putting all those factors together, the model, which is in blue, performs spectacularly well in evaluating gold and signaling to you whether the gold is under or overpriced. It tends to show you that gold is overpriced and is about to reach a peak when it trades below the gold price, and when it's above the gold price, it tells you that gold is at a lull, and when the valuation starts to increase, it signals a bull market in gold. There's a similar trend developed in silver. Well, in the last video that I produced on this, which was just a few days ago, I talked about how gold was looking to be at about $2,300 an ounce according to the valuation at the end of March, and that silver could go up to nearly $30 an ounce. But when we take into account current data right now, gold and silver's valuation drops. Gold drops all the way down to $1,900 an ounce. Silver drops down to below $26 an ounce, and those downward forces may explain why we're seeing a depression in the precious metals. Well, what factors have changed? One of them, and it's the major component of this, has been a rally in the US dollar. So despite rising inflation in the United States, the dollar index as a performance against a basket of currencies such as the pound, the yen, the euro, the yuan, and several others, it has appreciated by nearly 15% in the last year. Why? Because those nations are experiencing inflation too, and so foreign investors are buying US dollar-denominated assets. They're buying these dollar-denominated assets for several reasons. One is because with rising interest rates from the Fed, they're able to get a higher interest rate on US dollar debt versus their current debt, which may have more expansionary monetary policies. They don't care about rising inflation because all they want to do is just sell the dollar, sell those debt securities when they mature, roll them back over into their currencies, and with an appreciating dollar against their currencies, they're able to get more bang for their buck. Now, if we start seeing rising interest rates on this and they start buying longer-term treasuries and securities, then they're forced to hold those treasuries and securities to maturity, else they sell at a loss. That's when they're going to be trapped, and so recent reports have been showing that the U.S. Treasury's yield curve has steepened, and in other words, short-term Treasury rates have dropped relative to longer-term Treasury rates. Why? Because the Treasury rates, the interest rates fluctuate opposite to prices. The bond prices on those short-term Treasuries are going up despite the Fed raising interest rates. And the reason why is because foreign investors are buying those bonds in order to park their money on a short-term ends, safe haven-wise, to make that kind of short-term returns. But what this means is that the dollar and gold are in competition with each other, okay? They were in competition before during the 2000s, but there's a couple of things that work to gold's favor. One is that Unlike the falling interest rates caused by Fed money printing, which was bullish for bonds in 2008, 2009, and 2010, it's the reverse. We have rising interest rates, but what works against that is that rising interest rates attract yield-hungry investors to purchase those bonds, and they're not purchasing gold. The other factor that is weighing down on gold is the stock market. But wait a second. Haven't I been telling you that the drop in the stock market would be bullish for gold? That's true, but hold on one second. So stocks have dropped. The Dow Jones has dropped by over 10%. It dropped again today, which is a no-brainer. I've been forecasting this. This has happened. The Wilshire 5000, a broader measure of the stock market, has dropped by nearly 15% year to date, and it's on its way down even further more than the Dow Jones, because it also takes into account smaller cap stocks and tech stocks. But the problem is why those stocks are dropping. They're dropping in the wake of rising interest rates. And unfortunately, according to my interest valuation of the stock market that's based off the 30-year Treasury rate and the GDP growth rate over 5 years, stocks are not dropping as fast as the valuation of stocks are dropping, which means that relatively speaking, they're trading at a premium. Trading at a premium tells you that although money is flowing out of the stock market, there's still enough money buying into U.S. equities and retaining there that it's not causing the upward pressure in gold. In other words, gold is still competing with the dollar, and it's not winning outright yet because investors have not chosen to move their assets, to move their funds and wealth to gold. That's what's depressing these valuations right now. Now, could that change? Well, yes, it could. You could see a fall in the dollar brought on by rising interest rates, and I think that's one of the reasons why investors are buying these short-term securities and pushing up the value of the dollar, is that they're betting that inflation has peaked. According to a couple of reports that I've read, they're expecting the annual year-over-year inflation to drop to 8.2% from 8.6%, and when they turn out to be wrong, which will come out this Wednesday, then that might be bullish for gold, bearish for the dollar. Okay? Case in point, this model that I've created, which predicts the CPI inflation rate out 1 month from the last month's final demand, shows that the annual inflation rate will push up to 9.1%, at a minimum 8.6%. And this model has a 95% accuracy on this. So there's a 95% chance, statistically speaking, covering data going all the way back to 2010, that the annual inflation rate will range between 8.6 and 9.6%. So what does that mean? Well, when investor expectations and market expectations of a falling annual inflation rate and peak inflation turn out to be wrong, that should push a relatively downward pressure on the U.S. dollar. Now, I'm not saying it's going to break this bull market in the dollar by any means, but relatively speaking, that should cause somewhat of at least a temporary staggering in the dollar. Unfortunately, when we take out the long-term trend in the gold forecast based off the rising dollar and the fact that stocks are trading at a premium to their valuations according to interest rates, the outlook for gold doesn't look good. Now, this outlook is not accurate because these things can change in a heartbeat, but this is basically off of psychology here. So right now, before I was bullish on gold being at $2,300 an ounce and pushing up, now it's depressed to $1,900 and slowly pushing up over time. What changed? The rising value of the dollar, and although stocks are falling, they're not falling as fast as interest rates are rising, which still makes dollar-denominated assets attractive. Now, as the stock market continues to drop, and if they drop faster than the interest rates, that's going to push up the valuation. So when we do a test over here, and we start looking at where the stock market is going to trade relative to its capitalization and its profit, if we were to say that it trades right at its valuation instead of trading at a premium, then this is what it's going to do to the gold valuation. And hold on one second. Let me put this down. There we go. That's what it does. So gold bottoms out at 1900, and then by the end of the year, it's already pushing north of 2000 versus what it was doing before then. Okay, what it would be doing before then is that gold would not reach $2,000 an ounce according to its valuation. Now, gold can trade at a premium to its valuation, but since it's already trading at a discount to it, it would make it unlikely that gold would push over $2,000 an ounce before the year's end. Why? Because stocks are trading at a premium. The other factor is the dollar index, and that's your major component more than anything else. So what happens if we start seeing the dollar index start dropping again as investors become more fearing of rising price inflation? Well, that causes our gold forecast to skyrocket through the roof. If the dollar index were to drop, and say it were to drop to levels that it was in 2020, then the valuation of gold by the end of the year would be well north of $2,200 an ounce. Okay, so that's assuming that we start seeing a correction in the dollar index. There's no telling when that will hit, but psychologically speaking, if inflation expectations are missed, and especially if they go in the opposite direction to a big degree, and we start seeing psychologically the annual inflation rate come out over 9%, that could cause this reversal in the dollar. We'll see similar trends happen with silver, okay? So silver right now is forecasted to bottom out at around $25 to $26 and then slowly push up. Now, silver's trading at more of a bearish discount to its valuation, which makes silver a little bit more lucrative than gold, relatively speaking. And indeed, the silver valuation model has been very predictive. Another advantage that silver has is that when silver goes into a bull market, it trades at multiple values, multiples of its valuation. And so it can be very lucrative to make gains during the next bull market. Of course, with that, we're going to need to see a falling dollar index for that to rally. That's what caused the rally in the 2000s, was a falling dollar index, okay? And because you can see it right here that in the 2000s, the dollar index peaked at 118, and then it dropped all the way down to the 70s by 2008, which spawned on that precious metals rally. We saw something similar happen during the 1970s. In the early 1970s, the dollar index was 113, and by 1977, the dollar had dropped below 100. It had dropped 15%, which helped spurred that initial precious metal rally and the run up the first time in the silver market, along with rising inflation expectations, as well as stocks trading at a discount, at a big discount to their market valuations. Okay, so you can see time and time again throughout the years that stocks were trading well below where they should be valued according to interest rates, which was bullish for precious metals and gold. We're not seeing that right now. Stocks are trading at a premium to their valuations till we see that signal that capital is flowing out of U.S. dollar denominated assets. We won't see that real push up into the alternatives. I hate to spell it out that way, but I have to call it like it is. So outlook for gold and silver, not necessarily the best. Silver looks a little bit better as it's trading more cheaply compared to its valuation, but we can definitely see a turnaround if inflation numbers continue to build, especially if interest rates stay negative. If the Fed is not catching up to the inflation rate and the inflation rate's rising faster than the Fed's raising rates, that could, spur on the drop in the dollar index and panic could start to set in. Investors are parking their money in short-term cash equivalents and 1 to 3 month treasury bills and 1 to 2 year treasury bonds. That's going to come out at a relative loss even on the foreign investors markets. For even if those bond interest rates are at 1 to 2%, if their inflation rates in their domestic currency are rising at a faster rate and it's not being and it doesn't carry over in a rising dollar index, though it could and should, then what would happen there is that they would suffer losses. They would immediately dump those dollar-denominated assets. They would probably finally seek safe havens. So right now, the world is fooled into buying the dollar instead of parking their money into gold. So therefore, the valuation tool is not showing that increase and rise in the gold price just yet, I'm sorry to say. However, in future terms of expectations, gold tends to outperform during rising inflation, but that has to come with the falling dollar, and it needs to come with a stronger correction in the stock market. So be on the lookout. The more that stocks fall relative to interest rates, the more bullish gold becomes. Pay attention to that dollar index. We start seeing a correction in that dollar index, we could really start seeing some strong returns inside of gold as it starts to push up. So again, you know, like I said before, and I'll recap and then end this video, if we start seeing where the dollar index starts to drop and correct, that's going to be the biggest, most bullish sign for gold and silver, okay? So gold will push up well over $2,200 an ounce according to its valuation by the end of the year. And as we look into the outlook for the coming years, it will push up north of $2,500 an ounce, testing that $3,000 an ounce. Silver is going to see a similar trend. It's going to push over $30 an ounce, and it's going to start testing above $35 to $40. Of course, that's if we see that fall in the dollar index. So be on the lookout. The dollar starts trading inside of the mid to low 90s. That's going to be your signal. Of course, I'll produce a video dancing around and doing cartwheels while telling you this and trying not to make a fool of myself, because that would mean that the valuation tool is going to push up for gold and silver and is going to look for very, very strong returns and the continuation of the bull market that we've been seeing for the last 3 or 4 years. Guys, I hope you like the content that I produced. If you do, make sure you just drop that click that like button, drop a comment, let me know how you think, what you think about all of this, and let me know if I'm missing something, or let me know if I'm right on the dot. Cheer me on. I love to hear it. Subscribe to my channel if you haven't already. Click that notification bell so you're always notified when I do upload any kind of new content for your view. Once again, guys, I thank you for watching this video, and I'll talk to you next time.